Thanks, Mark, and hi, everyone. Thanks for joining us. I'm Laura Elkin, and I'm the Portfolio Manager for AEW UK REIT PLC. I've been part of the portfolio management team for the company since IPO some 10 years ago. AEW UK REIT PLC, or AEWU, is a London-listed REIT managed by AEW, one of the world's largest real estate managers. AEW is an award-winning strategy that has achieved the highest level of NAV total return of all diversified UK REITs, and its portfolio has outperformed the MSCI UK Balanced Funds Index over all timeframes since completion of its initial ramp-up. Within our market-leading total return, we generate a high level of income, which we use to pay the highest dividend in pence of any diversified UK REIT. So this has been paid at 2 pence per share per quarter for 37 consecutive quarters. So how do we do this? We maximize income, and we start by buying properties with net initial yields generally in the region of 7 to 10%. We like to buy low rented assets, creating opportunities to grow income in the portfolio. Our average passing rent across our portfolio at the moment is below £7, so a very low level. We buy properties in strong commercial locations because we believe that's key to driving tenant and investor demand, and therefore our performance. Once purchased, we very actively manage our assets to grow income and lengthen leases. As well as focusing on income, we also work hard to protect investors' capital and to unlock capital upside. So in order to do this, we use a value investment style that is unconstrained by sector. And we believe that really the only way to carry out a value investment strategy over the medium to long term is in a way that is unconstrained by sector. And in practice, this means that we look across the whole UK commercial property universe to identify mispricing and to seek value. A key metric for us is to buy assets that are showing a low capital value on purchase as compared to their vacant value or alternative use value. This protects capital value, but also brings important optionality for change of use into our business plans, which can be both defensive and also create opportunities to create significant value. So hopefully that's been a clear introduction to our strategy, and the next slide sets out some key metrics for AEWU. These are as at the 31st of December, so apologies, slightly out of date now, but we will release our next set of numbers in April. I won't discuss all of these because some are mentioned on upcoming slides, but just to pick out a few, we have 32 properties in our portfolio, 112 tenants. Also want to touch on the gap between our net initial yield and our reversionary yield, which stands today at around 75 basis points. Now, this is reflecting the amount by which our independent valuers expect that we can grow our income. Our vacancy level at just under 9% is in the region where we would expect it to be, in the range of between 5 and 10%. We're very much not scared of vacancy in our portfolio, and in fact, we see this as an opportunity. We believe that if we've bought the right priced asset in the right location, when we actively manage it, we can maximize its value. So actually, vacancy and lease events we see as an opportunity in order to drive value. Our debt at 60 million is showing in the gross LTV of around 25% and runs at a fixed cost of just under 3%. The geographical and sector weightings shown on the right-hand side. Now, when we make asset decisions for purchase, we make these very much in a bottom-up way, but this can lead us to taking some interesting sector positions. An example of this is around 3 years ago when we held about 60% of the portfolio in industrials and far less in retail. But naturally, by recycling capital and selling assets where we had made profit and buying assets where we found value, this has seen us to buy counter-cyclically, and we have taken some profit off the table in industrials and bought into the much unloved retail sector in a very selective way. Now, these mispriced retail assets that we've bought in recent years are now providing a real boost to our income and performance, and particularly with our most recent asset sale in Coventry, on which I've got a slide to follow. Our focus on defensive purchase pricing has also provided a boost recently, where other investors have been losing value in the office sector. Our approach to buy at defensive pricing levels close to alternative use values has meant that we've seen much fewer losses, and actually also some significant opportunities where we've added a lot of value, as in the case of an asset in Oxford. Now, at the start of the presentation, I stated that AEW had outperformed against its listed UK diversified peer group. And this is what you can see shown here by NAV total return. And for me, this chart really demonstrates the value of active asset management and crystallizing profit through well-timed sale. It's around the 4-year mark where we had been managing AEW and some of our asset business plans started to mature. And this is where you can see the lines in our performance starting to diverge. That same listed diversified peer group is shown here again, and you can see explicitly how AEW's performance has consistently been stronger as measured by NAV total return on the right-hand side of the page. AEW's share price performance has also been robust, trading much more closely to its NAV pricing than peers. I mentioned also that AEW had outperformed the MSCI UK Balanced Funds Index, and this is the case quite significantly over every timeframe since completion of our initial ramp-up. Our 5-year annualized outperformance has been close to 8% over this benchmark, proving that our strategy can deliver outperformance across a range of market cycles and also sometimes quite difficult market conditions. The next slide shows our dividend payment. Our dividend of 2 pence per share per quarter has been paid for 37 consecutive quarters. And these are shown annually here at 8 pence. The blip that you'll notice in year 3 is due to a change in our accounting period, but over the 12-month period, we did pay 8 pence. Now, as you might be getting slightly bored of hearing me say, we run an active strategy with assets being sold when values can be maximised to crystallise profit and then to recycle capital back into new return-driving opportunities. And what you are seeing on this slide is the impact that this active style has on our portfolio's income stream. Notably, around 2022, we sold our 2 largest assets in Oxford and Glasgow, and these were both sold to developers in order to maximise their value. And this saw us take both of those assets pretty close to vacancy, which created quite a significant knock on our income stream. And then obviously there was an inevitable reinvestment period, which also created cash drag. But I just want to reiterate that we are more than happy to do that in our strategy. Perhaps not every day to that extent, but because that drives the returns that we do. And because this active style is the driving force behind our total return outperformance, our board have been happy to support the payment of our stable market-leading dividend, even in these times of uncover. And this has been achieved using distributable reserves, so profit crystallized on prior sales. I just want to highlight that this total return approach to our dividend is a fundamentally different style to other REITs. And now it's important to say that this capital support for the dividend will not always be required. In fact, in the last 3 quarters, AEW has been fully invested and has achieved greater than 100% dividend cover within each quarter. Unfortunately, these are not shown here on this chart because we're just approaching our year end. But for the financial year ending March 2025, we are on track to show a high level of dividend cover by income. Just returning to the topic of profitable sales, this slide shows every asset sale made by AEW arranged historically. And you'll see that we have a strong record of crystallising profits on sale over a range of market conditions. It's this taking of capital profit that is driving the distributable reserves mentioned on the previous slide. Now, at year-end March 24, the distributable reserves level stood at around 25 million. And given the profitable sales made within the company over the last 12 months, it's pretty reasonable to expect that come the next year end, that figure is going to be higher. Now, if I can draw your attention to the right-hand side of the chart, you'll notice that the bar there, Coventry, has been our most recent sale. And on the next slide, I'll talk through the business plan for that asset in more detail. So Central 6 Retail Park in Coventry was bought in 2021 for 16.4 million, reflecting a capital value per square foot of £110 and a net initial yield of 11%. The asset had 25% vacancy at the time that we bought it, so it was feeling rather unloved. Our team identified, though, that the location looked very strong, being both close to the city centre, the train station, and being very accessible from the road network. The recent relaxation of planning laws allowed us to bring in a wider range of tenants to the retail park, and this drove footfall. We achieved a long-term letting to Aldi and to Iceland trading as food warehouse, and to a national dental operator. And this has resulted in something akin to a traditional high street, where customers can make a number of stops and prolong their dwell time. The asset is now fully let, with a net operating income some 50% higher than at purchase. We sold the asset in November for a price of around 26 million. Now, the sale of Coventry left us looking to reinvest and finding some significant opportunity in the current market. And as counter-cyclical buyers, we often find that in times of political uncertainty, we can find actually a lot of opportunity and particularly fruitful purchasing opportunity. And we saw this following the premiership of Liz Truss, when we had fortuitously sold our two largest assets in the lead-up. The subsequent period of opaque pricing strengthened our hand in negotiating with vendors, and we achieved some attractively priced purchases. So a similar effect is being seen at the moment, although not quite to the same extent. And we achieved one purchase last week, with another hopefully to follow very shortly. So last week we acquired this asset located on Bancroft and Portmill Lane in Hitchin, Hertfordshire. It's in a slightly smaller town than most in AEW, but one with a very affluent catchment, which of course works for a high street retail asset. The lot size of 10 million reflects a capital value of £210 per square foot and net initial yield of 8.3%. All of the tenants within these retail units are known to trade very strongly, which is one of the important measures for us when buying retail. We also know that despite that retail unit, all of the retail units being fully let, we know of various tenants who are interested in coming into the location, which clearly drives quite an interesting supply-demand dynamic. The capital value here is well below the surrounding residential levels, so the asset provides not only a strong income stream, but a defensive capital position as well. So before I conclude, I just want to touch on the industrial sector, because that represents not only the largest holding for a sector holding for the portfolio at around 40%, but it's the sector in which we see perhaps the greatest propensity for income growth over the next few years. And the successes of the industrial sector have been clearly well publicised, but we actually see some great opportunities coming up, and both to grow income and also capital. Now, you can see from the pictures here that the industrial assets owned in our portfolio are not the new build prime logistics units. These second-tier low-rented assets, where occupiers often can't afford to move premises due to rents having come on so much in the sector. And we're finding that this creates a strong negotiating position with our tenants at expiry or lease review. I'll just pick out one of the examples. So in Runcorn, we bought this asset back in 2015 with rents in the region of around £5 per square foot. By about 2023, we'd grown those rents to around £7 per square foot. But about 18 months ago, a tenant on the estate went into administration and was lost. Now, coming back to that theme that I mentioned at the start of the presentation, that vacancy can create opportunity for us. We took that unit back from the tenant who had failed, completed a refurbishment, and now we are letting that unit for a rent in the region of £9 per square foot. So showing how far the rents can grow, but also how opportunities can be created at times of vacancy. So I'd like to conclude with two main points. Firstly, that we are really proud of what the company has achieved. We've seen some great outperformance, but we still believe that the portfolio today represents a value proposition with low capital values and room for income growth, as demonstrated by the portfolio's independently assessed reversionary yield. Secondly, that our purchase in Hitchin last week and the next asset to follow, hopefully very shortly, are proof that our attractive pipeline is still very relevant at the current time. And to finish, I'd just urge anyone seeking greater information on the company to please visit our website or get in touch.
Laura, that's great. Thank you very much indeed, and some very useful insights there for investors. I guess one question, if I may, before we finish is, what should investors really expect from you over the next few years? What would you say to them?
Yeah, thanks. Well, over the next few years, I'd very much like to think that we would have continued our strong level of performance. Looking at our portfolio, and clearly I can't give out any specific details here, but we do see a lot of opportunity. And I've talked about how that's represented by the reversionary yield, but also specific assets where we're working on business plans at the moment for capital growth. Some of those are really exciting. I'd also like to think that over the coming few years, we can grow the company. And this is really just as a result of having looked at our pipeline very recently and reinvesting these proceeds from the sale of Coventry. We see a really attractive pipeline at the moment, and sometimes it can feel a bit frustrating that we aren't able to get our hands on all of that. We'd certainly like to have more purchasing power than we have at the moment. So growth within the company would be great, I think, for us as well.